The current state of the market is surprisingly similar to what we had pre-COVID, in part because the dynamics regarding private credit are more dependent on supply demand than they are outside influences, headline risk, or even frankly, what's going on with COVID. So the amount of capital that's been raised by private equity investors, and right now in North America, that's probably over 600 billion of dry powder, is dwarfing the amount of private credit dry powder, which is around 100 billion. And so the private equity clients are very anxious, as are their limited partners, to put money to work. And so relationship lenders such as Churchill have been very busy, really since the middle of last year, helping those clients with their financings. We had a record fourth quarter. We've had a strong first quarter. And so the dynamics, somewhat surprisingly, feel like kind of, the coast is clear. And even though we're still obviously in a pandemic, the deal-making market, both in terms of the large liquid loan market and also the middle market, continues to be pretty strong. I suspect that will continue for the rest of this year because, again, the technicals in terms of supply demand continue to be good. The economy has clearly been buoyant. We expect the first quarter GDP to be very strong, and because of short-term stimulus and other things that are going on policy-wise, it feels like the dynamics for deal making will continue to be beneficial really through the end of the year. We at Churchill have been preparing, or had been preparing, for a downturn for probably the last decade. Our investment strategy really didn't change at all from the post-recession, Great Recession timeframe, really through the beginning of 2020. We knew that in a downturn, in whatever form it was going to take, was going to impact more consumer-facing, more cyclical businesses. So historically, we stayed away from those sectors and focused more on defensive sectors such as healthcare, technology, software, specialty manufacturing, and so forth. And that really paid off during the pandemic last year. So we had no COVID-related defaults or losses throughout our entire portfolio, and in large part because of that discipline that we showed going into the period of March and April of last year. That continues now, so that what's clear, I think, for many investors is the distinction between what we call the haves, which are businesses that were either not affected by COVID or were actually beneficially impacted, to the have-nots, which were the companies that, for whatever reason, showed downturn in their revenues and cash flows last year, and may in some ways still be impacted by that. There's a spectrum, obviously, of performance. So businesses that are in, for example, restaurants and non-online retailers have been significantly impacted and arguably may never be the same. But the businesses that we focused on and continue in this environment to be very active in are these defensive sectors that I mentioned. And I think that has been the case pretty much throughout the markets. And so we've seen, even in the public equities markets, the valuations of businesses that have done well have been very strong. And we've seen purchase price multiples for the haves to be at or higher than pre-COVID levels as a result. Our focus has been direct lending, but we have 4 distinct strategies within that category. So we have senior debt, senior lending, junior capital providing. We also have fund-of-fund investments. So those are direct investments in the sponsors and the GPs with which we have relationships, and also equity co-investing. So even within the direct lending category, we have a diverse strategy, and that's been extremely helpful both for our issuer friends and our investors. For the issuers last year, one of the things that was not necessarily surprising because we've seen it in downturns before, but the prevalence of mezzanine investing and the need for these sponsors, particularly at the worst part of the crisis last year, when lenders were unwilling to provide, for example, unitranche financings that would extend leverage beyond, say, 5 times. We were very active in terms of providing mezzanine capital, which allowed the senior debt providers to, including ourselves, to be part of the capital structure and then have a junior capital piece as well. And that allowed sponsors to get deals done even at the more challenging parts of the cycle last year. As that evolved into the fall and end of last year, we found that it was not just mezzanine, but also unitranche and senior stretch financings became more prevalent. And so what we had by the fourth quarter was that all of our 4 strategies were ramping up pretty heavily, and that has continued in the first quarter of this year, and we suspect that will continue for a while. Investors, on the flip side of the coin, have found that the way that private credit and direct lending particularly behaved last year, particularly with practitioners such as ourselves who had this defensive strategy with their portfolio, found that a couple things happened. One was that yield started to increase because credit was scarce in the middle of last year. And while that improved as the year went on, they found that the spreads were still higher than pre-COVID levels. They've come back to earth a little bit recently, just based on competition. But in general, the thing that also impressed investors was the ability of practitioners such as ourselves to manage through that significant downturn without sustaining losses or defaults. And I think by that, the value proposition for direct lending, when you have sponsors as owners, was really reinforced. So I think that, while there's always an attraction to exotic financing ideas out there, and that's always the case, the latest bright shiny objects, the virtues of the way that we practice with more cash flow oriented lending, where you have, for the senior debt piece of it, consistent sort of high single digit returns, and then for junior capital and equity, obviously higher, has proven very attractive for a range of investors who are looking for stable yield, particularly in a still zero kind of rate environment at the short end of the yield curve. And then obviously going through unscathed, because credit selection was so important for us, was a big deal for investors. So they like that, and it's very hard to scale specialty financings because they're so opportunistic. Whereas with our business, it's very repetitive and easily scaled. Several differences. One is that the GFC was a real recession. So we saw in the second quarter, we had a significant dip, obviously, in the GDP here in the US. I think it was down 30% from the first quarter. And but then that was the end of the downturn. The third quarter came back and it was 30% up. So in a way, we didn't even really have a true recession. Now, the downturn was probably the most cataclysmic decline in 100 years. So that was real, but the snapback was real as well. So in some situations, even though the downturn was like the 08-09 period, it was really compressed to a short period of time. The thing that's different now, as I mentioned, is there's a sense of, the coast is clear. And so even though we're really still in a pandemic and there's still infections that are abounding, particularly outside the US, investors really and deal doers are really kind of viewing that, we've moved on now. Vaccines are going to basically fix the problem, and are looking ahead to a better economy, to interest rates rising, potential inflation, and all that. That's very different than we saw in 08-09, where it took a long time to kind of get back to that point of recovery. In some ways, the challenge is going to be for people like ourselves to get the message across to the market and to investors that, there's still possibility to make mistakes. There's still possibility of companies not performing well in this environment. Unemployment is still high, and risks are not necessarily completely off the table. So we look as investors very carefully at every transaction. We look at each company closely for any signs of problems on a monthly basis. And unless they're in sectors that are pretty well protected at this point, we're probably not going to be leaning in. That kind of cautionary approach has served us well historically over the last 15 years. And so I think that while everybody feels, I think, like partying, in some ways that's kind of an emotional release to being stuck in their homes for 14 months. I think there is still reason for caution. So I hope things don't get too robust too quickly. We're actually in the process of rolling out a presentation that I think it's entitled Private Credit Coming of Age in a post-COVID era. And that really kind of tells it all in terms of our view of the next several years. The private credit asset class was born really out of the Great Recession, because that's when banks got out of the business, and the stability of the asset class, particularly in terms of its non-correlated relationship to public assets and more traded strategies, became really important for investors, because they didn't want to be whipsawed by every bad headline that came out. And also the illiquidity premium, the yield that was much improved over both broadly syndicated and also high yield bonds. And so that was really helpful. There's been a tremendous amount of capital raised for private credit over that period of time. But the COVID period really allowed private credit to come of age, because what it did is allow investors to sort of put people like Churchill to the desk and say, okay, you've been talking about how you operate. Let's see how you did during that COVID period. And having, in our case, looking through our portfolio and saying, you guys did pretty well. So actually your thesis works. How quickly can you now put money to work for us? And that kind of approach is the kind of thing we think over the next several years is going to be really interesting, given two different dynamics now post-COVID. One is interest rates. So we know that people are expecting the long end. In fact, the long end of the Treasury has gone up significantly over the last 6 months. While the short end has not, I think the expectation is that there will be pressure on that over time. And we're a floating rate asset class, so that's going to be beneficial for us. And the second thing, which is interesting, is inflation. So the Fed has said, don't worry about inflation. It's going to be short term. We're not worried about rising prices. There's so much room to grow, given, again, the amount of unemployment out there, the sectors that are really challenged. But I think long term, I think inflation, which generally has proven to be have positive correlation to private credit returns and volume, I think the combination of interest rates going up and inflation going up as well, which at the end of the day is really all about the improved economy. I think those factors, which has been really different than we saw going into the COVID period, are going to be very beneficial in a way, kind of supporting further the private credit thesis, which is why we think that the asset class came of age, and we're probably looking for a really nice run over the next 2 to 3 years, and maybe even beyond.